You open your phone and you see that a lot of YouTubers and analysts are investing in this certain stock. You got curious and look at the company. You see its stock price skyrocketing to the moon. You felt excited that this is a quick way to make money and had the urge to quickly jump in to buy the stock. But after a while, when all the hype subsided, just as how fast it went up, it went down at the same rate, cutting your money more than half. In investing, this is a normal scenario, especially for starting investors. Now, the start is always the hardest, and usually the phase where you make a lot of wrong decisions, especially if you don't have any clue on where to get the right knowledge for investing. Now, although in investing, you can't be right all the time, even the best investors make mistakes. What's important is to learn from it and be a better investor the next time. So for today, instead of having to experience such mistakes, I will share with you the top investing mistakes that investors make and why you should start avoiding them as early as possible to develop the right habit and mentality that will help you survive your journey towards financial success through stock market investing. The first one was exampled a while ago, investing based on speculation. Listening to the big guys, what the analysts in the news channels say, what some YouTubers are recommending. If you always buy based on what others are telling you, then you are bound to lose a lot of money in the end. Although sometimes you can be lucky when you get in early and sell fast enough before the big guys cash in their profits, but this doesn't happen often. What happens most of the time is, we small investors lose a lot of money. The problem of a lot of investors is, they tend to just gamble their way in the stock market. What they fail to realize is that what you're buying and selling is not just stocks. These are real companies. As Peter Lynch said, I think you have to learn that there's a company behind every stock and that there's only one real reason why stocks go up. Companies go from doing poorly to doing well, or small companies grow to large companies. So at the end of the day, what matters is if the company is doing well and if it's providing a good amount of earnings and growth each year. No matter what the hype is, it will fall again if its financials are trash. What you should be doing instead of listening to hot trending stocks is to invest in the companies you know and understand. Warren Buffett calls this investing in your circle of competence. By investing in the companies you know and trust, you can be calm even when the stock price of the company you bought falls. Unlike those who just relied on pure speculation, they tend to panic quickly since they don't know if the financials of the company they invested in are strong. Unlike the one who understands the company he holds, sometimes he would even buy more of the shares of that company since he knows that it's a strong company and is now trading at a fair price. This is probably the best way to survive for a long time in stocks. By investing in what you know, you can stay calm in both market cycles. Like in a bull market when stocks are at an all-time high, you know you need to stay patient and not be led by the hype. And during a market recession when stocks are cheap, you know the companies you need to buy. Applying the principle of being fearful when others are greedy and to be greedy when others are fearful. And speaking of knowing the company you are investing in, one platform that can help you research about the companies you want to buy and keep you updated about the companies you hold is simply Wall Street. I've been using this platform for a long time to keep track on my stocks and my portfolio, and I really like how they notify me every time there's an update of the stocks I put in my watch list. And the best thing about it, it also computes the intrinsic value of the companies for you. This way you can have a guide if that company is undervalued or not. So if you want to sign up, do click my link down below. They offer a forever free basic plan, and with my link, you will have a 14-day free trial of all their platform's features. And that's not all. If you want to avail their product, by using my link, you get a 30% discount. Anyways, back to the video. The second mistake a lot of beginners make is being too active. Now this doesn't only apply to buying and selling. Some investors always look at the charts of the stocks they are holding. It's like praying for it to go up and up every day. But that doesn't work that way. The stock market doesn't care about you cheering for the companies you hold, and you can even make yourself panic by doing this. Since you always see the ups and downs of the market, this can lead you to make irrational decisions, like being frustrated that after you bought the stock, it suddenly dropped, or getting hyped when the stock suddenly rises and end up buying more shares again and again since you can see those small gains. One more, when you actively participate in the buying and selling of stocks, this also puts you at a disadvantage since you incur unnecessary fees and taxes. Now you may not notice it in the short term, but in the long run, fees also compound. As John Bogle said, where returns are concerned, time is your friend, and where costs are concerned, time is your enemy. In the stock market, what we want is compounding to work for us, not against us. Third mistake, most investors don't have a clear goal and a plan. Well, I think you've already heard of the saying that if you don't have a plan, then you're planning to fail. This is also applicable to investing. But to start having a plan, you first need to create a goal. As for me, I wanted to retire early based on the dividends I get yearly. So with that in mind, I started to create a plan based on my goal, which is to buy great companies that are undervalued that gives off a good amount of dividends, and to reinvest every dividend and capital gains I get to the cheapest company in my watch list, this to maximize the effect of compounding interest. If you take my strategy as an example, my plan revolves around my goal. So if you skip this step of defining your goal and plan, then you just be investing without any pathway to follow. And having a plan also provides motivation, since when creating one, you provide milestones for yourself. And when you achieve your milestones, you get that sense of fulfillment, making you want to move further to achieve more of it. This is what we call the dopamine trail, which can really help you stay in it for the long run. But be aware, when creating a plan or setting out your milestones, be sure it's achievable and at the same time challenging as well. Because if you just set out a plan that is too easy for you, then you won't strive harder to be better. For example, this year you want to invest 10% of your income per month to achieve a 60K investment milestone. The next year, you now push for 80K. This way, you're pushing yourself to put aside more money for your investments. So defining one's goal and a plan does not only help out in creating an investment strategy, it can also help you out in managing your money properly, which in turn also benefits your investments. Fourth, and this one I wish I knew earlier before I even bought my first stock, investing without a margin of safety. I mentioned this one a while ago, which is computing the intrinsic value. But having computed the intrinsic value of a company isn't enough, since it's just a projection and can be prone to mistakes and certain biases. For us to at least give a cushion for those mistakes we've done in our calculation, a margin of safety is required. The great Warren Buffett always emphasizes this one, the three most important words in investing, margin of safety. And he explained it very well. You don't drive a truck that weighs 9,000 pounds across a bridge that says limit 10,000 pounds because you can't be that sure about it. As explained, this is also applicable to computing a stock's intrinsic value. You will never be sure about your growth projections for the company. You aren't sure if there's a lurking pandemic or another tech or real estate bubble, and sometimes an inside problem for the company, or as simple as you using a very high growth percentage because of your bias towards that company. Now, I had this mistake back then when I bought my first stocks. I learned how to compute the intrinsic value of a company, then everything was on sale, so I just bought everything since I considered that it was undervalued. Little did I know that I was using a very high growth projection. But even though I used a growth percentage that high, if only I put a margin of safety, I wouldn't have had a high buy price for those companies. Now don't get me wrong, having a margin of safety still doesn't guarantee you're safe whenever the price of the company goes down, but at least it somehow maybe lessens the errors in your calculation. So even if you're so sure about your projections, always have a margin of safety. There is no rule for it. If you want 50% MOS, then go use it. But as for me, I always use a 30% MOS for my buy below price. It's my go-to percentage. It all depends on your risk tolerance. But a reminder, if you always use a very high MOS, then you may not be able to buy any stock. It would take a massive crash for you to be able to buy one. Now, if you want to know how I compute the intrinsic value of a company, I have a video for it which I'll leave the link below. So it's good to have a guide in your investing journey rather than just riding along with a trend or what some analyst or some YouTuber is saying. Start first by defining your goal and creating a proper plan that suits you the most, and don't get discouraged about the mistakes you've done. Rather, be more motivated by it. Learn from it and apply the things you've learned so that you will become a better investor. So if you've learned something from today and still haven't clicked the like button, then do click it before you leave. And if you still haven't tried out Simply Wall Street, then try it now. There's nothing to lose, and I tell you, it will upgrade your investing journey. So go get your free trial, and if you want to continue getting the full function of their platform, then use my link and get a 30% off of your subscription. So thank you, and see you in the next video.